Let's broaden it out and talk about the U.S. economy experiencing a faster rate of growth than expected in the fourth quarter. The latest data highlighting consumer resilience despite ongoing concerns of a slowdown. For more on what the latest signposts indicate about the state of the economy, let's welcome in Thomas Simons, Jefferies senior U.S. economist. Thomas, thanks for being here. So your note in reaction to this I thought was interesting, where you say you were expecting a capital K, maybe now it's a lowercase k. Basically what you're talking about is the resilience in particular of the middle to upper income consumer, if I'm reading it right. So how strong is that group right now?
So for the second half of last year, I think it's undeniable that they were very strong. We've been looking for this pullback in spending, and you're looking at credit metrics deteriorating and more reliance on things like buy now, pay later, and just thinking about the accumulated level of inflation that we've experienced for the last couple of years, it seems like the consumer should be sort of ripe for a slowdown. But instead, the second half of this year was quite strong. We had very strong spending over the summer on recreational activities and all sorts of other services as the economy really experienced the most normal sort of summer, most sort of similar to pre-pandemic conditions summer that we've seen in 4 years. And they continue that momentum into the holiday season as well. I'm skeptical that we'll get a continuance of that as we get through into Q1. But at least for now, it looks like the consumer was, back to its old ways in terms of the American spirit here for the second half of 2023.
Yeah, Thomas, it's interesting just kind of coming through some of the earnings report we got recently, just this week, Procter & Gamble, Kimberly-Clark, when you listen to them kind of talk about the consumer, they were saying, the consumer's looking okay. It's holding up here. I am interested, Thomas, to get your take on the labor market. I don't know if you heard, Julie and I were just talking about that. Yeah. It certainly seems sturdy now, Thomas, sub 4% unemployment, wages growing. But when you look at the labor market over 2024, Thomas, what's the trajectory? What are you seeing there?
So I think we're probably about to hit a little bit of a soft patch in the labor market, especially if we do see this slowdown on the consumer side that we're expecting. There will be margin compression amongst businesses, right? So I think that what we've seen in the labor market data for the last few months is that there's been this decline in demand for labor that we can see with lower job postings, whether it's Indeed or the JOLTS data. We do see slightly fewer demand, slightly fewer openings, right? We also see the hours work data from the BLS that's coming down. So it seems like employers are shifting towards, trying to maybe cut shifts or shift more towards part-time work rather than letting people go. I do think that there's still amongst businesses this idea that it was really, really hard to find people in the, sort of post-pandemic recovery period. It's going to be really hard to find people again at some point if there is, even if people start to get let go. So the jobless claims data has been really low. I think that there's probably some element of, perhaps a lack of a sense of urgency on people who have been laid off, because it's been relatively easy for most of them to go get a new job following a layoff in the last year or so. Also, a lot of people, especially in these tech firms that are higher income earners, probably sitting on a substantial amount of savings and household equity that they can rely on. So it's not like it was in, say, 2007 when everybody was levered to the eyeballs in mortgage debt. And if you lost your job, you knew you were going to lose your house very quickly. We'll see if, conditions evolve towards that. But so far, we're sort of at this long plateau period, I think, in the top of the cycle for the labor market.
So that's reassuring that people have a better cushion. But Thomas, when you look to year end, what is your target for unemployment? And where do you think we're going to see the most deterioration? Is it going to be, we've been talking about these sort of so-called white collar or tech jobs that are being cut, but do you think that there's going to be more pain to be had on sort of the lower wage side?
I actually still think that there's reasonably good demand on the lower wage side. The few areas that we still see substantial net hiring in the payroll data is in education, healthcare, and in leisure and hospitality, right? These tend to be, especially in leisure and hospitality, tend to be the sort of lower income hourly wage jobs. And so far, there's still a substantial deficit in the people working in those industries relative to the levels that we saw even in February of 2020. I think that we're going to see another leg of this more, I think good way to characterize this is how you did, right? Which is this white collar or, hoodie collar, I guess, type job in terms of, more layoffs in tech, probably some more layoffs in financial services. Seen a handful of the banks have, announced some pretty substantial cuts, and whether divisional or just some attrition type losses. But those are more higher paying jobs. That's going to be a threat to that top half of the K that we were talking about in our recovery scenario as well. So I think in terms of a point estimate for unemployment, I think we'll probably get somewhere around like 4.5, 4.6% by the end of the year. We're not talking about a sort of catastrophic decline in the labor market. It's really just a cooling off, the pause that refreshes, if we're going to reference an old Coca-Cola ad slogan.
And Thomas, I'm interested, just given your outlook here on the economy, the labor market, the consumer. What do you expect for the Fed in 2024, Thomas, in terms of when they're going to cut and by how much? I would think, and tell me if I'm wrong, if you're Jay Powell, you're not in a rush, are you? Because it's going pretty much as you wanted to see. The economy's growing, the labor market's sturdy, and inflation's cooling.
Yeah, I would say that it has gone how you would have wanted it to go, but I'm not sure that they have a tremendous amount of confidence that it's going to continue to be this kind of Goldilocks scenario going forward. Because in the history of economic data, it's extremely rare that you have a prolonged period of cooling inflation without a commensurate decline in aggregate demand or employment. So I think that by the time we get to March, that conditions will look a little bit worse. We will continue to see more disinflation, and I think they'll be comfortable with a 25 basis point cut at that point. I think they're going to want to go slow. We're not talking about an economy that's in free fall that they're trying to support with 50 or 75 basis point rate cuts like they had to do certainly in 2020 or in 2008. This is more just kind of a readjustment, right? So I think we probably end up with a total of 4 cuts. They stop by July, and then they sort of don't have to worry about accusations of meddling with the election and other political pressures there as well.
Thomas, it was great to have you kick off the show today. Thanks so much for your time. Appreciate it.
Of course. Thank you.